The economy is now slowing fast. Gross domestic product, or GDP, rose just 0.2% in the last quarter. So Australia is not officially in a recession, but it's on the way. When you take population growth into account, GDP fell 0.5%. The third quarter in a row, it hasn't gone up. So what Australians are feeling is a per capita recession.
Canada's economy is hitting the brakes. New data from Statistics Canada shows this country's gross domestic product flatlined in July and August, and early indicators suggest it'll be unchanged in September as well. If that happens, it will mean Canada's economy will show zero growth or potentially a contraction for the third quarter.
Two countries, two economies, over 13,000 miles apart, yet Australia and Canada find themselves in remarkably similar economic situations. Both are resource-rich, developed nations with stable governments and strong institutions. Both consistently rank highly for quality of life and economic freedom. But sadly, both are facing a convergence of economic challenges that threaten their future prosperity. Australia's 1.5% annual GDP growth compared favorably with many other rich nations, but it has only grown 2.1% above the last year, while the population has grown 2.4%. That means in GDP per capita, the economy has shrunk. For Canada, 2023 had weak economic growth and neared a recession. However, it is expected that Canadian real GDP may grow by only 0.9% in 2024. These figures for Canada and Australia are still well below the G20 averages of 2.2% and 2.7% for 2023 and 2024. In the last year, Australians have seen unemployment increase by 3.5%, the steepest drop on record, as the cost of living outpaces sluggish wage growth. It is estimated that Australian real wages will be 3.5% below their 2019 level by 2026. The story is much the same in Canada, where real incomes have been stagnant for years. Meanwhile, home prices and rents continue to skyrocket across Canadian cities, placing the dream of home ownership out of reach for many, while others remain saddled with the responsibility of paying off huge amounts of mortgage debt. In Melbourne, Australia alone, the proportion of income after tax used for mortgage payments has soared to over 45%. Immigration, long seen as an economic driver for both nations, is increasingly being viewed as exacerbating these issues, especially the housing crunch. Both governments have recently moved to restrict immigration levels in response to public pressure. However, hanging over all of this is stubbornly low productivity growth, weak business investment, and a lack of competition in key sectors. In this video, we'll elaborately talk on the economic realities facing Australia and Canada. With hard data and expert analysis, we'll examine the roots of these shared problems and the risks they pose to the future of these two Commonwealth nations. Are these two allied nations headed for economic reckoning? Let's begin by confronting one of the biggest elephants in the room, the housing crisis. In both Australia and Canada, the dream of owning a home is increasingly becoming a distant mirage for many, often tied to the immigration boom in both countries over the past few decades. The statistics on the housing crisis paints a grim picture, with soaring property prices outpacing income growth at an alarming rate. Although it is regarded as being more favorable than Canada, Australia's property market is routinely ranked as one of the most unaffordable in the world. In fact, only 5 cities worldwide are more unaffordable than Sydney for housing. With the median price in Sydney still north of 1.12 million Australian dollars, buying a house in most Australian cities still remains a far-fetched dream for many, despite the recent dip in the real estate market. In Canada, the situation has reached a tipping point, with extreme conditions for renters seeking accommodation described as needle-in-a-haystack type stuff. Over the years, the Canadian government has found itself grappling with the fallout of a housing bubble fueled by relentless immigration. Currently, Canada's housing market can be described as broken. The average national home price has increased by 0.8% year over year and now stands at a massive 716,000 Canadian dollars, rising to an absurd 1.2 million Canadian dollars in the Greater Toronto area. Rents in major cities like Vancouver and Toronto commonly exceed 2,000 Canadian dollars per month for a one-bedroom apartment. No wonder a recent survey found that 6 in 10, or 63% of Canadians who don't own a home continue to feel owning a home is completely out of reach. Meanwhile, those who have stretched to buy are saddled with alarming levels of mortgage debt. Canadians now owe a whopping $2.1 trillion in mortgage debt, a figure that has doubled in just the last decade. The household debt to disposable income ratio, a key measure of financial strain, now stands at an all-time high of 181.6%. For their Aussie counterparts, the great Australian dream of home ownership is slipping away for many. Home ownership rates have plunged 12 percentage points for the 35 to 44 age bracket since 1991. For 25 to 34-year-olds, it's even more grim, dropping from 52% to just 37% over that period. Australia's rental market is similarly a house of horrors. The vacancy rate across the country has dipped to only 0.9%. In regional areas, it's even more acute, with some northern New South Wales towns reporting a vacancy rate of 0.1%, functionally zero. To make matters worse for the Australian economy, workers' productivity dropped by a steep 3.7% as employment surged, but output failed to keep pace, making it part of a long-term trend of stagnant productivity growth seen over the years. Since 2005, labor productivity in Australia has grown at an anemic rate of just 1.1% per year on average. The story is depressingly similar in Canada, where productivity growth has averaged a meager 0.8% annually over the years. Over the most recent 10-year period of data available from 2013 to 2022, the growth rate has been cut in half and averaged only 1.0% annually. Furthermore, labor productivity growth was negative in both 2021 and 2022. This is a trend that needs to be flipped quickly if living standards are going to improve. By comparison, the U.S. has seen annual productivity gains in recent times. The nation's productivity increased by 2.7% in 2023. In the fourth quarter alone, labor productivity grew by 3.2% in the non-farm business sector and 1.3% in the manufacturing sector, more than double the rate from 2005 to 2019. Productivity growth is important as it is a key driver of rising living standards over time. When workers can produce more per hour worked, it enables higher wages, lower consumer prices, and an overall improvement in quality of life. This is why sluggish productivity has condemned both economies to slower growth and stagnant incomes. Economists point to several factors behind the weak productivity numbers in Australia and Canada: low rates of automation and technology adoption by businesses, a lack of competitive pressure in many industries, decline in capital investment affecting rates of entrepreneurship, and new business formation. Australia's capital investment as a share of GDP has fallen nearly continuously since 2012 and now stands at just 24.3%, well below the 28 to 30% range that prevailed in the 1980s. Canada has seen an even more precipitous drop, with private sector investment plunging from a high of 21% of GDP in 2014 to just 16% today, one of the lowest levels in the G7. This is a testament to the fact that fewer dollars are being spent in new machinery, scientific research, technology, and infrastructure. The oil and gas sector, long a bulwark of Canada's economy, has been particularly hard hit by the lack of infrastructure investment. Even though figures are projected to increase in the coming years, capital spending in the sector has cratered by nearly two-thirds since the heady days of 2014, falling from $81 billion to just $31 billion as of 2020. In Australia, where the mining industry is the main contributor to GDP, the lack of capital investment may also be contributing to the slight decrease in GDP contribution since the dawn of the mining boom. Even outside mining, the picture is grim. Non-mining business investment has flatlined at around 9% of GDP in recent years, well below the 17% levels of the early 1960s. Australia now ranks last among OECD nations for manufacturing investment as a share of GDP. The costs of this underinvestment are mounting for both Canada and Australia. In an increasingly competitive global economy, firms that skimp on investment risk falling behind their international rivals in terms of efficiency, innovation, and product quality. Indeed, both Canada and Australia have seen their share of global exports decline significantly in recent decades, a trend that low capital investment has no doubt exacerbated. Canada's share of world merchandise exports has been cut nearly in half since 2000, falling from 4.3% to just 2.3%. Australia has fared little better, with its share dropping from 1.2% to 0.9% over that same period. But merchandise exports rely heavily on productivity, and as aforementioned, over the past 20 years, labor productivity growth in Canada has averaged a paltry 0.8% per year, less than half of the 1.7% managed in the previous 2 decades. Canada now ranks a dismal 26th out of 36 OECD countries in terms of productivity levels, behind not just the US but also smaller economies like Belgium and Ireland. The story is much the same in Australia. Multi-factor productivity growth, which measures the efficiency of both labor and capital inputs, has been even more dismal, averaging a mere 0.2% annually over the past 20 years. So like Canada, Australia is also losing ground to its international peers. Among OECD nations, Australia's labor productivity level has fallen from 15th in 2000 to 22nd today. Its gap with the United States has widened from 20% in the early 1990s to nearly 40% today. From the slow-crawling GDP per capita growth to the declining real wage growth, the consequences of this productivity stagnation on both countries are already being felt. Although both countries rely heavily on immigration to beef up its labor force, it comes with its own woes. Canada and Australia, being top on the list of the world's most popular destinations for international migrants, are grappling with a complex and increasingly controversial question: what level of immigration is right for their societies and economies? While both countries have a long history of welcoming newcomers, the sheer scale of immigration in recent years has begun to strain the social fabric and economic foundations of these two Commonwealth nations. From skyrocketing housing and rental costs to stagnant wages, indigents are asking whether the once unquestionable economic benefits of immigration are now being outweighed by its costs. Canada stands out for its enthusiastic embrace of immigration. Prior to the pandemic, Canada was welcoming over 300,000 permanent residents annually, one of the highest intake rates per capita in the world. As a share of its population, Canada's annual immigration rate is nearly triple that of the United States. The Trudeau government has made no secret of its ambitions to further ramp up immigration, setting a goal of admitting over 400,000 permanent residents per year, totaling 1.3 million new immigrants by 2024. Proponents argue this influx is necessary to offset Canada's low birth rates and aging population, and to address mounting labor shortages in key sectors. But critics counter that such rapid population growth is exacerbating already severe housing affordability issues. One report concluded that for every 1% increase in population from immigration, rents in the destination city increase by 0.8%. As demand for housing and available jobs are on the rise, it's rapidly driving up housing prices and stagnation wages at an unprecedented rate. And since income isn't growing in tandem with house prices, more Canadians are forced to give up the dreams of home ownership. The story is all too familiar in Australia as well. Prior to the pandemic, net overseas migration averaged over 200,000 annually, accounting for 60% of population growth. At its peak, Australia's population was growing at 1.6 per year, approximately 400,000 people, well above the OECD average. Like Canada, this rapid population growth has coincided with an explosion in home prices and rents. While immigration is far from the only factor driving these spiraling housing costs, it is undeniably a significant contributor. The sheer volume of new arrivals, especially in major cities, has put immense strain on available housing supply. This is particularly true in the rental market, where many new immigrants initially settle. Despite the conventional wisdom that immigration boosts productivity by bringing in new skills and ideas, both Canada and Australia have actually seen their productivity growth stagnate as immigration has accelerated. Some economists argue that by allowing businesses to rely on cheap, imported labor rather than investing in productivity-enhancing technology, high immigration may actually be holding back efficiency gains. The various dilemmas facing Canada and Australia represent a complex and contentious challenge with far-reaching implications for both nations' economic and social futures. As these costs mount, both countries find themselves at a crossroads. Do they continue on the path of high immigration, betting that long-term benefits will ultimately outweigh the short-term disruptions? Or do they scale back immigration, risking slower growth and an aging population, and potentially easing pressures on infrastructure, housing, and social cohesion? There are no easy answers. Both countries need to find balance and figure out how to tackle the strain immigration is putting on basic amenities and resources while boosting innovation and productivity. If you like this video, hit the like button and help us spread the word. And remember to subscribe to get notifications on our latest news and analysis. In the meantime, check out one of these videos here to learn more. Thanks for watching.